maybe sends his preference bit to everyone. If he's corrupt, he can send different values to different people, which is something we don't like actually, because many times if you want when you want to broadcast, you would like to make sure as a person receiving the broadcast that yes, everyone else got the same information as me. So in some sense this is like a very useful application. So let's just talk about it again in the form of people and general in the generals problem. Just that assume that here out of the 5 generals, one of them is a commander, and basically the people decide that whatever the commander tells, if the commander tells to attack, we attack, and if the commander tells to retreat, we retreat. But the problem is that they don't know that the commander is actually working against them. So what they want to make sure is can you be sure that you get the same bit from the commander, everyone. Although he can send the different bits to each of you, you do some protocol within yourself to come to an agreement. So can any of you guess how would you do this? Okay. So the protocol is pretty simple. So basically what you would do is you let the commander send whatever attack or retreat to everyone, and now as everyone has their own preferences, you can run a Byzantine agreement on it. Does that make sense? So that would mean that finally, because you run a Byzantine agreement on it, everyone has the same bit, and then decide, depending on what the agreement gives you, attack or retreat, you either attack or retreat. This would mean that everyone gets the same message and can act together. So basically this is the requirements of reliable broadcast. Basically the requirements of first is consistency, is that all honest parties must arrive at the same conclusion. It's the same as Byzantine agreement, and again, yeah, we want everyone to get the same bit from this thing. Validity is the commander is honest, then all the honest parties get the output which the commander wants to broadcast. So if the commander wants to broadcast attack, you should not receive retreat, whatever happens. If he gives attack to everyone, you want to attack, if he is honest at least. Termination again is that it should terminate in a finite number of nodes. This is basically liveness. Yeah, then the protocol is also pretty clear, right? You can just share your bits and then do a Byzantine agreement. Yeah, this is a simple protocol for this. You send and then you run a Byzantine agreement. So why is this useful is like one important application is in blockchain, where you maintain a public ledger of all the transactions which happen. And now you don't want anyone to tamper with the ledger, that some people you say that you did the transaction, some people you didn't do the transaction. So in some sense this is useful, where you need to basically give everyone that I did the transaction or I didn't do the transaction. So once someone's ledger has that they did the transaction, it means that everyone received the same message. Obviously in blockchain you have to do more. You can't just write a message, you need to give some proof, and it should have encryption so that you can't make a new message, making like, although you didn't make a transaction, you can't say you made a transaction, etc. But this one part of it, you need real level broadcast also. Yeah, so this is where we end our talk. Thank you. Have any questions?
I have a question. I didn't understand one thing. For the first protocol where T was less than n by 4, when you were explaining the proof of property 2, can you go to that slide?
Yeah. Tell about property 2 where...
the first protocol.
Yes.
So in a phase, if the phase king is an honest phase king,
Yeah.
there were two cases. One is if every honest party gets a strong majority, and
Right.
another case is only if some of the honest parties get the strong. So
Yes.
my question was, in the case that no one gets the strong majority, they raise out to the phase king.
Yes.
And since it's a honest phase king, you get the bit of what the phase king prefers. right?
Yes.
And everyone does that. So if the face king who is honest, he had a bit, let's say he wanted to attack. After this, everyone is going to attack.
Yes.
Irrespective of what the actual majority of honest parties are. Let's say
Yes.
there are 10 people, 3 corrupt people.
Yes, I agree. I think you understood. What you mean is like if 6 people want to attack,
Yeah.
and we won't attack.
6 people want to attack, and 4 people want to not attack,
Right.
and all these 10 are honest.
Right.
Now we are basically, the final protocol is basically based on some random one honest party.
Yes.
So isn't it like more natural that if 8 people want to attack, all of them should conclude to attack?
So I think that that is not possible with this protocol, because what I would do as an adversary is kind of maybe try to act honestly, but say if the majority's attack, I will just say I want to retreat and act honestly, act the honest face me. I said retreat to everyone in that sense.
I didn't get your.
I mean, what I am telling is an non-honest face king can act honestly, but except of saying attack, although the majority is attack, he is going to just send retreat to everyone. And people will just follow that, and what will happen is after that phase, everyone will start retreating. This is possible. So the thing is, the Byzantine agreement doesn't like guarantee a majority will get the bit, like the majority. It just guarantees that everyone gets the same bit. So I think if we have lesser adversaries, you would get a majority. Like if it's what do you say? If the majority is like a bigger majority, maybe like a larger minority,
I get you. Like,
then you will always get the majority bit. I'm not exactly sure about the analysis for that, but that is the case.
yeah. So yeah, I get you.
But it doesn't guarantee a majority. It
The
just
chance
guarantees.
is good. If the majority is like
Yes.
a very high ratio.
If the majority is very high, then the adversaries can't change the majority too much.
But the thing is, when you had defined consistency, that was like slightly weaker, right?
Yes, it is weaker.
Everyone should come up to a same conclusion.
Yes.
But that was like kind of everyone. Probably a better thing is like everyone should come to a same conclusion. That is the majority of it.
That is the majority of the honest parties. That is a conclusion which you would want to do.
Yeah.
So the problem with it is, assume there are 7 honest parties and 3 corrupt. And maybe you want to say that 3 want to retreat and 4 want to attack in the honest parties.
Okay.
Now what the corrupt parties will do, they'll act completely honestly, but they will say retreat. From there they'll act completely honestly. So basically the corrupt parties' votes can basically flip the majority. So in that sense, because no one is acting corrupt, although the majority of the honest parties is attacked, you will still retreat. So in some sense you can't help it, because they change the majority themselves. So you need to more properly define what a majority would be, and maybe then you might be able to make a protocol, but most likely this is what you can do. You can't give more guarantees for that part more than this. That's why this is.
Basically, in simpler terms, you can't differentiate between a corrupt party who's acting corruptly and a corrupt party who's acting honestly.
Okay.
Like a corrupt party can still act honestly for the sake of his personal wishes, but he's still corrupt, and you don't want the opinions of the corrupt to. We cannot guarantee that in this protocol.
No, I think the definition is if all the majority, if all the honest parties agree on a decision,
Then
then the final
Yeah.
one. So if that is not the case, if the honest parties, because they are taking individual decision, there may be variation in that.
So like
In
what?
that case,
Yeah.
we don't guarantee anything on the conclusion. The conclusion is that everyone will agree to something, that's all. But that may not be the agreement of even the majority of the honest
Right.
parties.
So what he wanted is, can we make a protocol that would be the majority?
That is possible if you have 1/5 of the parties are corrupt. That is because you have 4K honest 4K plus 1 honest parties. The 4K plus honest parties, among them the majority will be 2K plus 1 honest parties. The 2K plus 1 can beat K easily and so on. Therefore, for that the number of corrupt parties should be even less.
Right.
And
Okay, but otherwise, for the 3 limit and other things, the only requirement is if. There is one big if. If all the honest parties happen to have the same conclusion, that is what the final consensus should also be arrived at. But if that is not the case, if honest parties' opinion are divided, in whatever way it is divided, it doesn't matter. The conclusion is going to be the same, but it may or may not agree with anything of the original configuration.
We can make a stronger statement.
You need the number of, you need more honest people to arrive at that conclusion, because it is done by voting, right? So honest parties are going to convey their opinion honestly. Therefore, there will be a honest majority of honest one would still be available, even if T correct parties behave in whatever way they like. Because there are 2K plus 1 honest party, and their view can never be overcome. That's the, it is a bit tricky, but that's the way. Anyway.
Yeah, any other question? Yeah, what is it?
Are there any now we have discussed around a strategy for n is greater than 40 and one for n is greater than 3. So has that been improved? So say in the case of traitors being less than half.
So it has been proved that you can't do better than n greater than 3t if you are wanting perfect security, where the adversaries have unlimited power. So basically, how in the morning Pandurangan sir taught the discrete log problem, which you could iterate through everything if you have unlimited power. So if you are given unlimited power, this is the best you can do. But if you can give, I think even with error or
No. Randomization is possible, but you can use digital signatures and other things for authentication and non-corrupting, and computationally with
t less than n by 2.
Yeah.
So if you have, if you can't solve such hard problems, the computationally bounded, then you can do for t less than n by 2. But talking about that requires a lot of crypto primitives, which is something which I didn't want to go over. This is more like even a high schooler can understand, because it's more logical reasoning.
Also, this is synchronous. We have the communication happening in an asynchronous manner, and for asynchronous one, even if one corrupt party is there, things are not going to work. Now forget about 1 by 3, t by 3 and t by n. It's a different model altogether, but there are a lot of interesting stuffs and the research. There is a framework of research. There is a matrix of problems in this beautiful matrix. Various conditions, adversaries, abilities, models. So the cross product of each entry will define one specific problem.
Communication
Beautiful framework.
But what did you mean by synchronous?
Huh?
What did you mean
Okay,
by
so I can. So synchronous is basically when you expect to receive a message, when you send a message, the other person receives it by a fixed time delta, before or by that. So basically, when you expect to receive a message, you just wait for delta time, and if you don't receive a message, you just say that he's a corrupt party, that's why he didn't send me the message. But in asynchronous, it models the real world more better, is that you would always receive your message when it's sent, but you don't know how much time it's going to take. So what the thing is, the corrupt parties, what he can do, the corrupt parties, what they can do is they won't send, they cannot send their message, and you will get n minus t honest messages. The other thing what can happen is, all corrupt parties send their messages, but their messages reach first. We give the power of corrupt parties to order the messages. So let's assume their messages reach first, and then n minus 2t honest parties messages reach, and we have t more honest parties whose message have been sent, but it's going to reach soon later. But as a person, I don't know if the other t parties who have not sent me are corrupt or honest. So we don't know if we should wait for them or not. So whatever we should do should be done with these n minus t responses. So here, if this n less than 3t, like not in Byzantine agreement, but generally if there's n less than 3t, the protocol goes to n less than 4t, because you need another t parties extra so that you can defer that n minus t parties, honest parties who don't give you the input in some sense. It makes life easier because asynchronous means that you don't have the delta, so you can assume that you can get messages fast and keep going. then your number of time will be reduced, but it is harder to make protocols.
Yes.
Any other questions? Okay, then I think.
Thank you.
That's good. There no time. Yes.
Sorry?
No, that's why I was kind of suggesting ESS, which is computationally you can demonstrate.
Next one.
Yeah,
Each
I
guy
know.
moving
I know this
something
one is
wrong,
stop.
everything
Like-
this is right, I will accept and kind of
This one
easy to
wrong.
demonstrate. But this is more fundamental and important. No doubt. Thanks.
Thank you, Palak, Rishi, and Shishir for that fascinating journey into paradoxical agreements. Up next, we have Rajul, Krishna, and Shubham, who will introduce us to the world of financial mathematics through their talk, The Black-Scholes Model. It's one of the most famous equations in modern finance, a formula that tried to do the impossible, put a precise price on uncertainty. Developed in the early 1970s, the Black-Scholes model revolutionized how traders valued options. So let's welcome Rajul, Krishna, and Shubham to decode how mathematics once tried to tame the unpredictability of human behavior. Thank you.
So good evening everyone. We will be talking about the Black-Scholes model today, a very famous model used to price options which are used in the stock market. So in the 1700s, when Newton retired after being a professor in Cambridge for decades, he had a lot of money. And as everyone would want, he too wanted his money to grow. So he invested it in the stock market. But the outcome didn't turn up as he wanted to, and he lost about a third of his wealth. When asked about it, he said that he could calculate the motion of heavenly bodies, but not the madness of people. So this basically suggested the need of a mathematical model to basically model the risk associated with the stock market. So a stock is basically a commodity which represents ownership in a company. As the company grows or it makes a loss, the person who holds the stock also does the same. So coming to the main question of what are options. So as the name suggests, an option provides the buyer an option to buy the stock at a predefined price known as the strike price at a later date. There are of two types, the call option and the put option. The call option basically provides you the right but not the obligation to buy an asset at a pre-specified price at a later date. If the prices go up, this option is very useful. On the other hand, the put option provides the right but not the obligation to sell an asset at a pre-specified price at a later date. It's useful if the prices are expected to go down. This pre-specified price is known as the strike price. So we can illustrate it with an example. Suppose the price of a share today is $100 and I buy the option, the call option, which basically provides me the right to buy a stock at a later date at $10. So this price which I paid to buy the option is known as the premium. And after 1 year, suppose the price goes up to $130. So I would exercise my right to buy the stock at $100 itself because I had bought the option before, and I would immediately sell it off. So I would make an immediate profit of $30, and I had paid $10 as the premium. So my total profit will be $20. On the other hand, if the price of the stock goes down to let's say $70, So I would not obviously use, I would not buy the stock because the price has gone down and I bought the option to buy it at a price of $100 itself. So the option would expire and I would only lose the $10 which I had paid as the premium. So this basically illustrates how options are useful in the stock market. So this is a graph which represents the change of the profit or loss you have as the price of the stock increases. So if the price of the stock remains lower and the increase in the price of the stock remains lower than the premium you paid, then the loss you make is limited to the premium you had paid. Whereas if it goes higher than that, then you book an immediate profit. So let's discuss a few advantages of options. They limit the downside. So options, as I told before, the loss, if the price of the stock does not increase more than the price you paid for the premium, the loss is capped to the price you paid as the premium. The second advantage is that they provide leverage. So for this, let's look at an example. So if you buy the stock for $100 and as the example suggested that the price goes up to $130 after 1 year, the profit you make is 30%. Whereas if I had bought the option, as we discussed earlier, the profit was $20. So that's a return of 200%. So basically, I do not need to invest my whole money in the price of the stock. I can control a large amount of stock by just buying the option. So with a small amount of money, I can control a larger number of stocks. The third advantage is that it can be used as a hedge. A hedge is nothing but an insurance. So you would not lose the whole amount the price goes down to in the stock, and you would only lose the price limited to the premium you had paid. So if you notice one more thing in this example, that if I bought the stock and booked a profit, the return was 30%. And if the stock price decreases, my return is minus 30%, that is I book a loss of 30%. Whereas if I had bought the option for $10, the price goes up, so my return is 200%. But if the price goes down, then the whole loss is the price of the premium I paid, which is 100%. So you can see options are way more riskier to deal with because the whole, if the price goes down, you can see it is 30% versus 100%. So it's a lot of difference. So there are many types of options, but we would discuss about a couple of them. So European options are the options which can be exercised only at the time of maturity they are bought for. Suppose they are bought for a period of 1 year, then I can only use it after 1 year. Whereas American options can be exercised any time between the present time to the time until expiration. So as I discussed, the risk in options is greater than in stocks because the prices can cause large gains or losses as well. So coming to the main question, how do I price these options so that the buyer of the option and the seller of the option both have an equal amount, an equal probability of booking a loss or a profit? It should not be unfair to anyone. So before that, we should understand how a stock itself is priced. So stock price are determined by a constant tug of war of the number of buyers and the number of sellers. If the number of buyers are more than the number of sellers, then there is a greater demand and hence the price goes up. If it's the opposite, the price goes down. Now the number of buyers and sellers depend on a large number of unpredictable factors. It could be geographical locations, natural calamities, geopolitical situations, or any kind of new innovations which come up. Now it's impossible to predict what's going to happen next, and hence we could safely say that the stock movements are unpredictable, and the probability of a stock price going up at any point in time is just as likely of it to go down. So we could say that the stock prices follow a random walk. And this randomness is what forms the foundation of all the modern pricing options, even the one we're going to present today, the Black-Scholes model. So coming to a quote that randomness is the hallmark of an efficient market. As we discussed earlier, the market is random. But what is an efficient market? An efficient market is basically, it states that it is impossible to make money by just buying a stock and selling it immediately. All the available information is already reflected in the stock prices, so it is not possible to outperform the market in any way. So we can understand this by an example. Suppose a company A there's a news in the market that it has booked a profit. All the people would immediately rush to buy the stock, and hence the price would go up immediately. And when you go to buy the stock, you would see that the prices have already inflated, and hence the information is already included in the market. So many random walks together form a normal distribution, which is known as the central limit theorem. In 1900, Louis Bachelard proposed that the stock prices move up and they follow a completely random walk, which is alike to the Brownian motion which is observed in the particles of physics. So he described this as the radiation of probabilities because it was very similar to the radiation of heat which was seen through a particle and a body. So he basically assumed that stock prices move continuously and randomly following a Brownian motion. The equation which he suggested is as follows, where St is the price of the stock at a time t, S0 is the current price, mu is basically the drift which represents the trend which the stock is likely to follow over a period of time. Sigma is the volatility which basically represents the risk associated with the stock and it represents the randomness as well. Wt is the variable which represents the standard Brownian motion. So stock prices are normally distributed as we had discussed earlier. So this was the equation he had suggested, and it was considered fair because the mean of all the outcomes was such that neither the buyer nor the seller gains an advantage, or there was equal probability of both of them booking a loss or a profit. So coming to the next idea, which was Thorpe's idea and which gave rise to hedging. So hedging is basically something which could protect you from the risk associated by basically dynamically changing the amount of profit or the loss you could make. So he introduced the idea of a portfolio, which was represented by V minus delta S, where V was the value of the option, delta the number of shares held to hedge the risk, and S was the value of the stock. So we could change delta dynamically by basically associating delta by the number of stocks, and the price of the stock changes with time. So delta was also dynamic. So let's understand this with an example. Let's say there's a stock which is priced today at $100. The strike price is $100, which means I could sell it at $100 at a later time. The call option is $10, which the premium paid is $10. So Bob buys one option from Alice for $10. So it's a call option, so he could buy the same stock at $100 at a later date as well. So Alice sells, and if the price rises, she must sell it to Bob because Bob has bought the option, even if it's worth more. So this would basically put Alice on a downside and she could book a loss. So to reduce the risk, Alan builds a portfolio and she buys 0.5 shares of the stock as a hedge. So let's look at this first scenario. Let's say the price of the stock goes up. So Alice would book a loss because she sold the option for $10, but the price has gone up by $20. So now Bob would gain $20 for the increase of the price and $10 as he paid as the premium. So the total profit would be $10. And Alice would lose $20 on the option, but she had bought a hedge for 0.5 shares, so even that goes up. So the total increase in the price is $10. Her net loss is hence $10, which would have been 20%. So she reduced the loss by 50%, which is a lot. So that is the main idea of dynamic hedging. Similarly, the second scenario follows. So now I would like to call Krishna to discuss the further mathematics about it.
Hello. So, hello everyone, I'm Krishna and I will be presenting the intuition and the motivation and at the end the mathematical derivation behind this Black-Scholes formula. Basically, as discussed till now, that owning an option is quite risky, and correspondingly owning a stock is not that risky, but you get a lesser return. So it's like a risk-return trade-off. So okay, that's a different thing. But what we want is that if we have some money, like assume that to be pi amount of money we are owning, we want that it should not depend on the randomness of the market. What does I mean by randomness of market? Like for example, tomorrow some crash occurs So it should not get decreased by that crash. It should keep on increasing by some R per interest rate, which turns out to be that the R turns out to be a risk-free interest rate, which I would be talking in the later part of the talk. The first thing is we will talk about the options, and the second thing is yeah. So one more problem was there in the initial model which people came up with. It was that they historically modeled it as the stock's price as a random walk. But there is a big problem here. If you assume that stock price is a random walk, you will get negative values of stock in many often cases. But that obviously is not a certain good condition. So we would, rather than modeling the price of stock as the random walk, you would assume that the logarithmic of stock price is doing the random walk, and it turns out it works well, and it gets us correct results. So we would assume that the D of LNS is having two terms. There is one deterministic term which is mu dt, which represents the if there is a pattern. Currently, this pattern holds after dt time interval also, and this sigma dx, which represents the randomness of the market. We would now go deeper into these terms. Okay. So the first term is deterministic part, and the second is stochastic part or randomness part. Basically, this dx, what we are modeling it as we are modeling it as a random walk, we are assuming that from t to t plus dt time interval, this dx is a random variable which follows a normal distribution with the mean equal to 0 and the standard deviation equal to dt. And if you, it turns out that when we would solve this using expectation values, this turns out that the dx whole square value is equal to dt, and hence this, when we square this ds term, it becomes ds whole square equal to sigma square s square dt, which we will be using later part. This would be used later. So this. So again, what was the motivation? The motivation was to reduce the risk of our portfolio, so that we don't have any risk. Whatever happens in the market, it might go very down or very up. Our portfolio should increase with the same R% interest rate. We don't want our money to be lost, just like Newton lost his money. So basically, we would take the d pi as the small change in our portfolio with t to t plus dt time interval. Okay. It turns out d pi is equal to dv minus del times of ds. Yeah. So now what we will try to find the dv, as v is a function of stock's price and the time. So we can expand this dv using the Ito's lemma, which is a type of the Taylor's theorem used for stochastic variables. Then you can see that there is a big problem, like how you are even assuming that ds whole square is there, which is not neglected, which we in general neglect in Taylor's theorem. So basically, the reason behind this is that in general, when we try to model a function from t to t plus dt time interval, a small time interval, it can be very better in a very better manner. You can get it as a tangent, but it turns out that when we are using a random walk and the dx is a normal distribution, the change is not very small, and this can be derived with stochastic calculus that this dx square is dt, and that ends up getting us ds square is sigma square s square dt. We put the dv's value into this, and we get here. Now what we want, the d pi should not have any random term, the dx term. So we would try to eliminate that term, and when we end up eliminating that term, we get delta, the hedging ratio equal to del v by del s. So basically, when we started with v minus del times of s, that del was actually del v by del s, so that our investment remains risk free. It means that whatever happens to market tomorrow, like it might be a crash or might happen something else, our portfolio would work well in this condition. Now we are assuming that there is some risk for interest rate. Like we are assuming, as we had reduced the dx term, hence there is only one deterministic term left, and here comes an assumption that if there is no randomness in the market follows a R interest rate, a compound interest rate law. So that d pi equal to r by dt is an assumption of the market that if there is no randomness in the market, this is how the things follows. And as we put the values, we get the famous Black-Scholes partial differential equation. And now from by solving this equation, we get the value of option, which we get the theoretical value of the option. And these are the values of the option. Here d1 is this. Okay. And these are the terms which we had used here. you can see while the part. Okay, so basically the idea behind this whole thing is that why are we doing, why are we even trying to model a options price? So basically, if we are able to price an option, we can get a theoretical value. And if we find out that the actual price of option is greater than the theoretical price, we can actually sell that option because we know that someday it would go down. Correspondingly, if you see it as like the price on an option is lesser than the actual theoretical price which we are taking out, so we can buy that option because we know tomorrow it would go up. So from this we can actually earn risk-free investment and okay. This leads to actually Black-Scholes equilibrium condition that if the price is greater than the options price is greater than the theoretical price, it goes down, and if the price is less than the theoretical price, it goes up. So now I would be giving to like Shubham to talk about the limitation and application of the Black-Scholes.
So since we have seen the mathematical part of it, now let's go into a quick example. So we have the stock price, current stock price is 100, strike price as 105, time was 1 year, and risk-free rate. Risk-free rate is a theoretical rate, interest rate that we assume that doesn't have any risk associated to it. We take it as the rate of the US Treasury bills because it is one of the most stable thing. So on putting these values in the model, we get the call price and the put price, the premium we have to pay as this and this. So this is very remarkable because we have converted the randomness into a neat mathematical expectation. So now we come to the application part of it. So Black-Scholes model is the backbone of the modern finance market. So it has revolutionized the market and made it into a multi-trillion-dollar industry. It is not just used for pricing an option, but for entire portfolios, its derivatives, and risk management framework. Banks and hedge funds use it to hedge their risks, and it is also used mainly for calculating the implied volatility. Implied volatility is a factor that gives us the expectation of how much the stock price would fluctuate in the near future by the values of the option prices now. So then we go to the cracks in the model. The model is very elegant because it is based on few assumptions, and we know that assumptions are where reality disagrees. So first thing is we assume that the volatility is constant, but in reality it doesn't. The volatility changes every second, and even a little spike in the volatility can deviate the model results by huge amount. Then we assume the returns to be normal distribution, but it's not. The market has many fat tail events, means extreme events. Like in the next slide, I will tell you a fat tail event, that is LTCM crisis. And other examples are 2008 financial crisis and 2020 COVID. And we assume the world to be frictionless. That means there is no transaction cost, there is no taxes, there is no restrictions on short selling, but in reality that doesn't happen. And we assume in this model that the market is continuous. That means we can trade at any point of time, we can buy it, we can sell it, but in reality it doesn't happen. There are trading halts. The model doesn't consider dividends. Dividends is a reward by the company to its stockholders for as a part of its profit, to encourage the other individuals to buy their stocks. Another thing is we assume in the model that the individuals are rational, but ultimately we all know that the market is driven by human psychology of fear and greed. So then we go to a very specific failure case, that is the LTCM catastrophe in 1998. So the LTCM was a hedge fund introduced in 1990s. So
its trading strategies were heavily based on BSM models, but until 1998 everything worked out beautifully. But in 1998 the Russian financial crisis happened, and volatility skyrocketed, and due to this their models collapsed, and at last the US Federal Reserve has to intervene a coordination of multi-billion dollars to prevent a global crisis. So now we go to another specific failure, that is the American dilemma. So as mentioned earlier, only European options can only be exercised on the expiration day, but American options can be exercised any day before the expiration. So this adds a whole new layer of complexity, that is what is the optimal time to exercise the option. So it was first a mathematical problem, but now it has become a computer science problem. So now, for to solve this, we I will give an intuition behind two special models. Since we don't have time enough, so I will just give the intuition. So first is binomial model. In this model, what we do is we uh, make the time into discrete steps, and at each step the price can either go up or down by a calculated amount, and then we backward go the tree, and at every point we calculate if it's valuable to exercise the option now, or exercise the option, or hold it. So here is one diagram for intuition. So the another thing is Monte Carlo simulation. So in this method, what we do is, it is pure brute force. So what we do is, we simulate millions of random future paths possible, and then we average out the results, and that is the optimal price. So at last we come to the conclusion. So the model isn't perfect, because it assumes many real world complexities, but it was the first breakthrough, or the first real bridge between physics, maths, and the financial market. It was the one that gave the whole industry a rational framework to build upon, and it is the failure that became the problem, created the next generation of complex models that we use today. We using data science, computational power, and machine learning models. So at last, the takeaway from us is, it is the hello world of quantitative finance, and you have to understand it before you can build anything else. Thank you.
Very nice attempt and comprehensive, nice presentation.
Any questions?
Any questions, please?
Yeah, that's good.
Thank you.
Last one. So you are taking picture of all presentation. Title of the slide, put the slide of the talk. It says thank you slide. Don't take a picture, thank you slide.
Thank you so much, presenters. Now let's shift from patterns we can see to knowledge we want to keep hidden. That's the essence of zero knowledge proofs. In cryptography, these are protocols where one party, the prover, can convince another party, the verifier, that a statement is true without revealing any additional information about the statement itself. Our following speakers, Murli, Ritvik, and Praharsh will guide us through both the theory and intuition behind these fascinating proofs, demonstrating how secrecy and verification can coexist. So please join me in welcoming them.
Good evening, everybody. Have you ever wondered how a website verifies your password and username without having the exact username and password? Because they won't. If they do 1:1 mapping, then your data will be compromised very easily. So, the essence is built on zero knowledge proof. The very basic foundation is zero knowledge proof. What is a zero knowledge proof? Zero knowledge proof is a very basic instrument that allows one party to prove that they have a piece of information without revealing what that piece of information is. The party that wants to prove is called the prover, and the party that wants to verify is called verifier. Very self-implicit names. These people were the ones who created this foundation for this, and they progressed the field of cryptography by a very large margin. So, in order for a proof to be known as zero knowledge proof, it needs to satisfy very basic conditions. There are three basic and elementary conditions. One is completeness. If the prover is correct, then he should be able to pass the test. Soundness. If the prover is wrong, basically if he is lying or cheating, he should get caught. Zero knowledge. In the entire proof, there should be no additional knowledge that should be revealed to the verifier. Now, an important assumption in this process is that our prover and verifier are both honest. Essentially, they are not cheating between the process itself, disregarding whether they are lying or not. They are not cheating through the process. Let us begin with a very basic, intuitive and non-mathematical proof. Where's Waldo? Most of you might have know this, but if you don't, it's very simple. Where's Waldo is a very colorful illustration of hundreds of characters doing random stuff, and our job is to find this guy over here. And I know where he is, over here. You probably don't know unless you have seen this before or have very exceptional eyesight. Now I want to prove to you that I know where he is without actually telling you where he is. This can be done in a very, very simple way. I will take a very large black sheet, which is much bigger in dimension than this actual illustration, and carve a small hole with Waldo in it. Now I will adjust my illustration behind this hole such that Waldo overlaps with that gap. Now I have proved to you that I know where he is without actually telling you where he is. That guy is actually over here, somewhere over here. So now let us check if this is an actual ZKP. Is it complete? If I know where he is, I can show you this proof. So it is completeness. Soundness, if I don't know where he is, I cannot perform this proof. I will get caught by you people. So it is sound. Is this zero knowledge? This is not completely zero knowledge. Because from this, from this gap, I can see the size of Waldo and what Waldo is doing. It gives me additional information. So this is not completely zero knowledge. But for a basic understanding, this is a good enough proof, which is not mathematical. Let us go to a more mathematical but simple proof, the three-colored graph proof. A graph is essentially a very basic structure that consists of vertices and edges. Vertices are those round things, and edges are lines that connect any two vertices. Now, a unique property of three-colored graph is that every single node is colored, and any nodes that are joined by an edge have different colors. If you observe here, no two same colored nodes are joined by an edge. Now this is a blank graph. I want to prove to you that I know a valid three-colored graph mapping for this without showing you what that graph is. How do I do this? First, I will take a random permutation of my original three-colored graph. This is a valid permutation. Permutation is essentially a random shuffling of colors. Like, take all the red colored nodes, make it into blue, take all the blue colored nodes, make it into green, and all the green colored nodes into red. And I won't show this to you, obviously. I won't show this to you. I'll keep this to myself. I will generate it. I will keep this to myself. And I will ask my friend to pick any one edge randomly. Suppose he picks the bottom right corner. then I will reveal the colors of the nodes that are joined by that edge. In a random permutation, maybe it's green and red. I will tell it's green and red. Now, if they're of the same color, I will get caught. I am lying, so I'll get caught immediately. If it's correct, it doesn't mean that my entire graph is correct, but at least I didn't get caught so far. Now, I will repeat this exercise again and again, many number of times until my friend gets convinced that my entire graph is correct. Now my claim is that this is a zero knowledge proof. Let us check if this is a valid zero knowledge proof. The three conditions are completeness, soundness and zero knowledge. For completeness, if I am correct, I should be able to pass the test every single time. And this is self-obvious. If my graph is correct, no matter what edge you choose, the colors of the edges, colors of the vertices will always be different. Soundness. Soundness implies that if I am lying, I should get caught. But the problem is, it's always a non-zero probability. Even if I am lying, suppose there is one edge that actually has the same color. But it depends on the verifier. If he never ends up choosing that edge, I will never get caught. So there is a non-zero probability that even if I am lying, I will escape. But luckily for us, in real-world cryptographic systems, a system is said to be sound if the probability of me lying and escaping is less than 1 by 2 power 128. For this particular system, you just have to ask me around 1050 times to repeat the same exercise, and after that, you should be convinced that yes, my entire graph is correct. As for zero knowledge, is this truly zero knowledge? Yes, it is. Because in every single exercise that you choose, I am choosing a completely random permutation and you are hopefully asking me a completely random edge. For example, this exercise you might have asked me this. In the next exercise I will choose a different permutation and you might ask me this edge. Now, the assumption over here is that me and my friend are both being random. Otherwise this will not work. If I am not being random and if I am choosing the permutation in a particular logic, then my friend will be able to join different pieces of information and he'll be able to get the original color mapping, which I do not want to happen. And if my friend is not being random and if he is very stupid and if he keeps choosing the same edge over and over again, nothing will get proved and every single time I will be getting different colors. So an important assumption over here is both me and my friend are random and honest. If I get red and red, I should say I'm getting red and red. I should not lie that I've got red and blue. So yeah, my friend Prash will continue with further.
Hi everyone, I am Prahesh and today now I am going to discuss some real life examples where ZKPs are used. So first of all I would like to start with Sudoku. So how can I show that I solved a Sudoku without revealing the solution? So like a few months ago, me and my friend were solving Sudoku and I told him that I solved it, but he did not believe me. He wanted me to prove it, but I can't reveal the solution of course. So I was wondering like how can I do it? And then while I was surfing through the net, I came across many different solutions and I'm going to give an overview of one of it. So it follows by mapping the Sudoku to a coloring graph problem. So how can we map the Sudoku to a coloring graph problem? So let's discuss about the 4x4 Sudoku and then we can extrapolate it to n by n. Now this is the solved 4x4 Sudoku. Now I assign a color to each of the number. So like 2 gets a color, 1 gets a color and each get different color for example. And then here each unit square we consider it as a vertex and then we join the vertices such that for example take this vertex and then we join it with the vertices in its row, in its column and in the same box with an edge. And now since the rows, columns and boxes don't have the same color, so all the edges have two different colored vertices. So this simplifies it down to the coloring graph problem again, and then you can do the same protocol which Ritik discussed before. But this is just an overview of it and it's not exactly an ZKP because it has soundness issue and we can discuss it after the talk actually. And now I would like to discuss about interactive versus non-interactive ZKPs. So what an interactive ZKP is, as the name suggests, it contains interaction. So there's back and forth conversation between the prover and the verifier. So the one we did before, the coloring graph problem, is an example of interactive ZKP. But of course this is very inefficient, because if the verifier is very stubborn, he will ask for like hundreds of thousands of interactions. So it's very time consuming, and then after you proved it to a verifier, for example, if there's another verifier who wants to get convinced, so you have to go through this process again thousands of times. So it's very inefficient. Next is non-interactive ZKP. So it's just a single message from the prover to the verifier, which contains all the information which is required to convince the verifier. And so once you send the single message, any number of verifiers can look into it. So it's very time efficient, and one way to visualize it is using the Bayes folder again, even though it's not exactly a ZKP. And this is mainly used in blockchains and everywhere. And with it would continue from here.
Another real life application of the ZKP, especially the colored graph problem, is the mobile network towers. Imagine I own a mobile service network, imagine I own Geo, and I have several network towers. There is a problem with network towers. If they are in a similar locality, and if they share the same frequency, it would cause interference, due to which interference happens. We do not want that to happen. So the government asked me to prove that there is no interference happening in my entire network, and I want to prove it to them, but I do not want to tell them, show them my explicit network, because that is my network. I do not want to give them the optimizations and all those things. So I can do this by converting it into a colored graph. I can consider every single tower as a particular vertex as a node, and if they are in the same locality, I will join them by an edge, and each frequency I will be assigning a 1:1 color. Now each frequency will have one color, and each locality, in a locality if two towers are there, they'll be joined by a vertex. So joined by an edge. Now this is the exactly same simulation as a colored graph problem. So I can simulate this and show to the government that my entire network towering is perfectly, absolutely fine. There is no issue with it, without actually revealing them any information of what frequencies I'm using, or the entire network of towers is still undisclosed to them. They don't know anything about it. My friend Murli will continue after this.
So I'd like to discuss about another example of ZKPs, Hamiltonian circuit. So what is a Hamiltonian cycle? A Hamiltonian cycle is a path in a graph which visits every vertex exactly once, and then comes back to the starting vertex again. So you as a prover want to prove to your friend that given a particular graph G, you know the Hamiltonian circuit to that graph. So you obviously can't tell the exact path to the graph as it would reveal the solution. So what you do is you construct a isomorphic graph to the graph and name it H. So an isomorphic graph is a graph which shares a similar structure to the original graph, but the ordering of the vertices is different. So if you have a Hamiltonian cycle in the graph G, that would imply you have a Hamiltonian cycle in the graph H, because isomorphism is just like mapping vertices. Here 1, 2, 3, 4, 5 are mapped to C, B, E, D and A. So now you present the verifier with two questions. Either he can ask about the isomorphism, or he could question you about the Hamiltonian cycle. If he asks about the isomorphism, you can just reveal the mapping of the vertices. And if he questions about the Hamiltonian cycle, then you would reveal the Hamiltonian cycle in your H graph. Note that the verifier can't ask both the questions in a single exercise, as that would reveal the map. So now we have to prove that this is a ZKP. In order to do that, we have to prove completeness, soundness and zero knowledge. If you are true, then you would, if your proof is correct, then you would have a valid isomorphism and a valid Hamiltonian cycle in graph G. So that would imply you have a valid Hamiltonian cycle in graph H. So you would pass every exercise. If you are lying, then that means you are either lying about the isomorphism or the Hamiltonian cycle. So at some point when the verifier asks about what you are lying, you would get caught, proving soundness. So in order to prove zero knowledge, you have to prove that the verifier knows nothing after the exercise is done. He knows nothing except that the fact that your proof is correct. So let's say the verifier asks about the isomorphism. You just reveal the vertices and not the Hamiltonian path. So the verifier doesn't know anything for the fact except that for the mapping. So he doesn't know the Hamiltonian cycle. And if he asks about the Hamiltonian cycle, you reveal that cycle in the graph H. So he doesn't know about the Hamiltonian cycle in graph G. He won't know the full information to connect to the graph G. So that's proving the zero knowledge. Now the above mentioned every theorem works when when you the prover and the verifier are in the same room and you can have a one-to-one interaction. But what if you both are like far away from each other? The verifier can't trust you anymore because you can lie, obviously. So to tackle that situation, we use commitment schemes. A commitment scheme is a scheme which has two operations: commit and reveal. Commit is like locking, like putting your answer in a box and then locking it and giving that box to the verifier, keeping the key to yourself. Reveal is like giving that key to the verifier so he can open that box and see the answer. Now the verifier can trust that after he opens the box, he will see the answer you initially put in because you locked that box. So this resolves the trust issue. We implement this commitment scheme using hash functions. So what is a hash functions? Those are the functions which satisfy the following properties. For any message m, hash function is very easy to compute and it is a fixed length of characters. And it is a one-way function. That means given y equals to h of x, it is computationally infeasible to find x. And this is the basis of cryptography and it is collision free. That means it is very hard to find messages m1 and m2 such that h of m1 equals to h of m2, and it will take very long time. So how do we implement commit function using hash functions? To implement this, let's take the example of 3-coloring graph problem. So you want to lock your answer, like you colored your graph and the color of a particular node is purple. So now you append some random bits, say 101101. So you append those random bits to the purple string and then hash that key. So you send that output to the verifier, hash of purple 101101, and then that completes the commit. To implement the reveal thing, you'll send that color and the random appended bits to the verifier. So now he can verify using hash to what you sent as your key and then the previous result you sent. If they both are same, then you are honest and that's the real value in the box. If they are not same, then you are lying and your proof is wrong. So what we discussed in this talk is just a brief overview of zero knowledge proof. This is a very broad topic and used in modern cryptography and blockchain technologies and all. If you are interested, please look into it. Thank you. Any question? Thank you. Thank you. Thank you.
So good, that is the end of day 1. So tomorrow we start at 10:30, right? Again, 10 o'clock we have anyway the tea is arranged. 10 we will start with the tea and then relaxed. We can come here for the session. And same lunch break is also at 1 to 2 and other. The schedule is same? Because we have to ask them to bring food accordingly. That's the only issue. So, like today, all snacks and other arrangement can come at the same time. The hall will be available from 9:30
Thank you to all the presenters and all the professors who presented today. And this is the end of day 1, and tomorrow we'll begin. The tea will be served, tea and coffee will be served at 10 a.m. and the event will officially begin at 10:30. Thank you so much for attending. Thank you.